rates are keeping homes off the market. I mean, inventory is low, but you have to move. You've got a new job, you just got married, you just got divorced, a life event, but you feel stuck. That's what I want to talk about today. I'm keeping it simple. The 6 ways you can buy before you sell, because ultimately high interest rates only mean that monthly payment is going to be impacted, but you might have life that is just keeping you moving, yet your equity is tied in that home and the perfect home comes on the market. I don't know how to juggle that. I don't know how to take advantage of that. So let's go through these 6 ways to buy before you sell, because I will tell you, a little strategy goes a very long way in today's market. And as we see interest rates drop going into next year, you've got to know that it's only going to get more intense. Now, if you can live with a fixer-upper or a home on a busy street, you're going to find that you have negotiating power. That home is not moving as quickly as some of the ones that are priced right and staged right. On that one, you have tons of options, but that's not the one you love. It just so happens that the one you love was priced perfectly and staged perfectly, and you better guess that it's going to have multiple offers in the first day. So here's how you buy before you sell. Number 1, the easiest solution, the least competitive or the least capable in a competitive situation, but of course the most opportunistic in a less competitive situation, and that's going contingent. We are finding if you price your home right and stage it right, and it's of course nestled in the right neighborhood, they're moving very fast. And in fact, they're moving still for over asking. So if you're working with a real estate agent that has been able to do the market research and knows that this house is going to move fast and can give that sense of confidence to the listing agent, you might be able to go contingent in this market, especially if you're putting an offer on a listing that has been on the market for more than 1 weekend. Those sellers are looking to move and they'll take a contingent offer. That's the easiest and the most common of ways. I want to go into the other ways. All right, number 2 is using the equity from your current home. So there are primarily 2 ways to do this, and then I'm going to give you a third. The 2 ways that everybody can think about is a HELOC or HELoan, a home equity line of credit or home equity loan, and then a cash out refinance. Really quickly, both of those tap into the equity. Now, your home cannot be listed at the time you're doing a HELOC, a HELoan, or cash out refinance. So ideally, you might be keeping this home as a rental property after you move. If you want to sell it, you're definitely not going to do the cash out refinance. It's more expensive than a HELOC. But a HELOC is going to be on a variable rate. And I don't know if you've checked prime rates lately, but they're 8.25%. I mean, we all got spoiled when prime rates were 3.25% when the Fed rate was 0. That's not the case today. Today, the prime rate is 8.25%, and I can guarantee you tomorrow it'll be 8.5%, and then more than likely in September it'll be 8.75%. And HELOCs, home equity lines of credit, are based on prime plus something. That something is based on your risk. How much, what's your loan to value, what's your credit score, what's your credit history. Those things will determine that plus factor. So it's going to be 8.25% or more. So that HELOC can be an expensive option, but it's flexible. I only pay interest once I draw the money. So I can get a home equity line of credit while I'm under contract on a new home purchase, then tap in, pull out that equity to put as the down payment on the new home. A cash out refinance, you can do it, but you usually have to get ahead of the game, and you're going to have more costs associated with a cash out refinance than a HELOC. Typically, if you have any costs at all, it's going to be a couple of $100 maybe for title and or for an appraisal, but it's going to be minimal. Now, if you end up selling that home after you buy the new home, you will have an early termination fee with the HELOC, which typically runs around $350. And the cash out refinance has other implications for the lender because typically those loans need to be held for 6 months or longer. All right, that's the HELOC and the cash out equity. We do a lot of home equity lines of credit, helping our buyers get that equity, pull it out, get into the new property, and then convert that to a rental, knowing that we're going to refinance that into a 30-year fix down the road. The third option for pulling cash out of an existing home is a bridge loan. So the bridge loan differs from the cash out or the HELOC in the fact that you can't use either of those first two if your home's already listed. If your home is listed, that's when you'll want to use a bridge loan. That bridge loan will become a second loan on your existing home, tapping into the equity that is remaining based on the market value less your loan. And you'll be able to use that bridge loan to pay the down payment on the new home. Now, the bridge loan is probably the most expensive of those three options because the bank knows, because of the premise of the loan, that it's very short term. So they're not going to make their money on the interest over the long run. They're going to make their money in actually originating that loan, and then you're going to pay it off typically within a couple of months, maybe as long as 6 to 12 months. So they're going to charge you a couple of points up front and then an interest rate while you hold that loan. Here's the downside to all three of those options. You have to qualify with the loans, all of them, the existing and the new. The only way you could get out of that is if you have a lease on your existing home, if you use the cash out or the HELOC, and I'm going to turn it into a rental and I can get a lease and I use 75% of that lease. I'm telling you, working with a lender that understands the rental market, investments, and strategy is gold in this market. A little strategy goes a very long way. All right, so back to the bridge loan. I'm gonna have to qualify for the first loan, the bridge loan, and then the purchase loan. So it's a little bit cumbersome, and depending on your income, that might be a deal killer. The third option. So we talked about contingency and we talked about tapping into the equity of your existing home. Third option is a 401k loan or drawing money from one of your investments. Now you can cash out stocks if you have a stock account, or you can do a loan from a retirement account. And good to know, that loan against your retirement account is seen, or from your investment account, is seen as a loan against yourself. So that loan's monthly payment, because you're going to want to repay it, is not counted against your debt to income ratio. So if you have access to funds like this that you can take a loan against, that money is going to be cheaper than a bridge loan and act in the exact same way. So you're going to have your first mortgage still. Hopefully you're listing your home. You're going to sell it quickly. Then you're going to tap into a retirement account or investment account. You're either going to draw those funds or you're going to take a loan against them. And then you're going to purchase the new home. And once you sell the old home, hopefully you'll pay that loan back. If you're not planning on selling the home again, you're turning it into rental, you can look at paying that loan back slowly over time. I know 401k loans, they can come out of your paycheck. But again, the big benefit, I don't have to count that against your debt to income ratio. All right, number 4, gift funds. Super easy way to jump into the next loan. So if you can get anything, even if it's 5% as a gift, we can qualify you based on your original home and whether or not you're getting a lease on it and the new home using the gift funds as the down payment. If I do something like that, and say maybe I have the benefit of getting a gift for the entire purchase price, which we're seeing a lot of those right now, especially when you have older parents who have done well in the stock market, or maybe they have their own equity and they have the money cash to buy in a highly competitive market, full cash, knowing that they want that money back after closing to repay whatever access point they got those funds from. We're seeing a lot of that where we are paying it for cash, knowing full well there'll be a loan right behind it. So you know, there is something called, and this is the 5th, is a delayed financing opportunity. All right. So if I'm going to buy it with cash, I can do delayed financing. I can pay that cash back immediately in under the 12 months. So Fannie Mae and Freddie Mac now require you to wait 12 months to pull cash out of a home that you've purchased, but not with delayed financing. With delayed financing, I can pull that cash out in under 6 months, paying whatever resource I used to get that money. So that is a fantastic option. Delayed financing, buying it with cash, the 401k loan, tapping into the equity, and contingent. So we're moved on to number 6, because here's a gold mine of a new program that our team just tapped into. So this program is called the Trade Up program. And it works similar but different than some of the iBuyer programs. And I want to explain it because it's yet another tool in our tool belt. It is not the perfect solution for everybody. None of these are. All of them have nuances that we need to look at based on your specific circumstances. Do you have enough assets to draw a loan from? Do you have enough equity to tap into? Do you have the resources to pay cash? Do you have the opportunity, and are you putting an offer in on a home that will take a contingent offer? All of them have specific nuances that we need to walk through. So here's the last one, the trade-up program, number 6. If you have a home to sell, but you don't believe it's going to sell prior to you needing to buy, and or it's a competitive market, the home just came on the market, they will not take a contingent offer, you need to go in either all cash or non-contingent. You can do that with the trade-up program. So here's the deal. Your agent can be listing your home. You're going to go non-contingent because we're going to use this trade-up program. If the agent sells your home prior to you buying the new home, then you'll just do it as a non-contingent, sold before you buy. Should your home not sell, and there's no cost for that solution, none. So this is a guarantee and it's insurance that only has a cost if you execute it. You can go in non-contingent, and if you sell your home, you don't need the program. It was just sitting here as a backup and at no cost. If your home does not sell before the closing on your new home, you can execute on the trade-up program. Now, the trade-up program is going to buy your existing home at an 80% loan to value, pay off your mortgage, and give you any equity remaining. That way, you no longer have to approve with the 2 or 3, if you do a bridge loan, mortgages. Now we've removed all of your other mortgages and you're only qualifying with the new home. Your realtor is going to continue to list that home, and they're going to hopefully sell it for market or above market price. And as soon as that happens, you've since moved into your home, you're all good, you feel comfortable and confident, you've taken the equity from the first set of the first part of the transaction and you've put it down on the new home, you've closed on that new home, and now your real estate agent has closed on the sale of your previous home. You get the remaining equity out of that after the convenience fee of using the trade-up program, which is 1.9%, and you're able to take the remainder of the balance, and you can actually do something where you can buy down the principal called recasting and get a lower monthly payment and a lower loan balance. So the Ruth team here at Movement Mortgage, we service all of our own loans. So a lot of these options where you tapped into the equity and you put a smaller amount down than you ultimately want to, you can recast at any point and drop that loan balance and drop that monthly payment. I mean, we're just talking options, right? None of these 6 are the ultimate solution. None are better than the other. But having all 6 tools, in addition to all the other tools that we have in our tool belt, are the opportunity to get you into a home. Thinking strategy, thinking positivity, thinking taking advantage of a market where interest rates are high, demand is low, getting into the home of your dreams, and then refinancing it when the opportunity presents. Because home ownership is where the opportunities and financial stability and security lie. Well, I hope you guys have a great rest of your day and week. Nicole Ruth with the Ruth team. I'll talk to you soon.